Peter Rose, Longwood Currency Trading. Good morning. It's a brutally cold mid-January 2022 day. I want to talk to you about how you increase your trade size. How do you go about doing that? It's not so simple as to say, oh, I'm trading a $10,000 account, I'll add 20,000 more and I'll trade 30,000 size. There's some steps that we need to take and some concerns that need to be made. Now, most of the time in thinking about increasing trade size, the conversation or the thought process is, I'm going to take my small account and I'm going to grow that so that then I'll have a larger account to trade. Unfortunately, it doesn't work that way. There are folks, many folks, experienced folks, that can take a small account and grow that through this incremental compounding. You start at 50 cents a pip and you work your way up, and you're going to take a $200 account to $600. Great. Let's say that you could take the $200 to $1,000. Is that going to change your lifestyle? No, it's not. Is that what you want to do? If you could double that $200 and to $400 or $500 or $600 or $800, you do that every year. That's not what you want to do. What do you want to do? You want to trade a $30,000 account to $100,000, or you would like to trade a couple $100,000 account. That's great. But I think $30,000 is probably a good place to target that would probably produce some significant income. Now, I don't know what kind of percentage you're going to be able to get on your bank a year. 20% on your money on 30,000 buck risk is a $6,000 increase, and you say, "Oh shit, man, $6,000, that won't help me at all." Really? It's not going to help you that much if you're making $200,000 or $100,000 a year. But if you're making $30,000 a year, or even, the average wage today is in 2022 is around $50,000, at $51,000 or $2,000. Probably a little less than that, because remember, the average is taking all these guys that are making $200,000 or $150,000. So look, if you're making $30,000 to $40,000 a year, that's probably a lot of us out there that are in the workforce. Well, I'm not in the workforce anymore, and I retired as a software engineer, making a lot more than that. But the clerks that work in the banks, the store shop workers, the guys cutting wood for a living for somebody else, or shoveling snow, or apprentice help or something, you might be 40,000 or something. Let's say you're at $30,000. Would $6,000 more a year affect your life? Well, yeah, of course it would. And so let's be reasonable about the amount of money that we are expecting from our returns. Now that's just 20%. You get better than that on real estate. I spent 40 years in real estate. It's better than 20%. And there's a lot of places where you can get, a long-term index fund is, I don't know, if you pick the right time frame, you could be 8%. I think over 20 or 30 years, you could probably figure that an index fund, a good one, will get you 8%. If you get 6% on it, you're doing pretty good a year. Let's say that you have the skills to make a 20% return on your risk, 6,000 bucks on a 30, and that you're making $30,000 a year, and so that's a significant thing for you. If you can develop those skills, then the thing is, I'll take that skill and I'll go from a $30,000 account to a $60,000 to a $100,000 or whatever size account. That's great. That's what you're going to do in the future. What are you going to do right now today when you only have a few $1,000s that you can apply toward your trading and your education? Start with one mini and learn your skill. Now there's two ways of trading larger size. One is like I've just been talking about, going from a $10,000 to a $20,000 size, then $20,000 to a $40,000 size. I'm not saying that you're making that money to go up in size. I'm saying that you're jumping in size. So there's those increments in your learning. You're going from let's say from a $20,000 account to a $40,000 account. That's about the situation you'd kind of like to be in. Well, you're at the same kind of quandary when you're looking at a $1,000 account and going to a $2,000 account, or a $2,000 account to a $4,000 account, or a $3,000 account. How do you make those transitions? You can't make them by thinking that you're going to earn the money that's going to give you the ability to do that jump. That's called compounding. And if you don't understand compounding and you apply it incorrectly, which you're all going to do, you're going to end up losing your money because you don't understand the risk component that goes with the compounding. All you think is, I'm trading it $1 a pip today, and I'll trade it $1.25, and then $1.26, and then $1.35. You can't do that because you have to make those calculations all the way through. How about this? How about if you take that $1,000 mini account and you trade that until you're consistent over a long enough period of time that you say, oh, I would be comfortable trading a $2,000 account. And then you put another $1,000 in your account, or take what you've made and add to it. So you have $2,000, and now you trade a $2,000 account. I don't think you're going to want to go from a $1,000 account to a $30,000 account. That I'll talk about later. In compounding, you're compounding in quantum jumps. The issue with compounding at whether you're trading a mini lot at $1,000 bank or a $100,000 bank and trade $100 a pip, it doesn't make any difference. Every time you make some money, you increase the bid size. You increase the amount of your lot size that you're trading. So you're going to go from trading 1 mini lot to 1.1 mini lots to 1.12 mini lots. That's the compounding effect. You need a spreadsheet to run that, and you're doing all those calculations as you go through. It doesn't make any difference whether you're doing that or you're at a $100,000 account level trading $100 a pip, and then you're going to trade $110 a pip and $112. It doesn't make any difference. You need a spreadsheet to do that. Is that what you want to focus on? You want to focus on, oh geez, I'm going here trading from $30 a point to $31.50. Is that what are you supposed to be focusing on? You're supposed to be focusing on following your rules, looking at the trade setup. You don't want to distract yourself, and compounding distracts you from the trading. Einstein said that compounding is the seventh wonder of the world. That's great if you know how to use it. A shotgun's a wonderful thing if you know how to use it. If you point it in the wrong direction, you'll blow your ass off. If you trade and compound the wrong way, you're going to lose your money. Compounding is not a guarantee that you're going to make money. Risk management has to be correlated with that. When I teach the simplicity of trading. Start with $1,000. When you become consistent, then you can go to $2,000. When you've done that successfully, maybe you go to a $10,000 account. And then once you trade a $10,000 account and you're consistent, then you can go to a $20,000. You go from 20 to 40. You double, basically, is a comfortable trading level increase in the ability. And I'll talk about that in a minute. Let me talk about this consistency of trading. Consistency isn't taking all of your trades over the course of the year and saying, oh, on average I made X number of dollars a day. Because you have to look at your equity curve. Let's say that your capability of trading is $100 a day, that you're making $100 a day. You have the expectations, I'm going to make about $100 a day. But in your equity curve, we see $500 a day losses in places, $600 a day losses. And then you make that up by getting $800 a day, one day, winner. That's not consistency in trading. That's averaged luck. That's a false sense of security. If that's your equity curve, you do not want to jump up your trade size until you become consistent. And that consistency is $100 a day. Maybe some days you'll do 150, maybe some days you'll lose 100 or 150, but you're going to stay within certain boundary ranges. Now, I can't tell you what that is. I don't know what your circumstances are. I don't know what size bank you're trading with. That's going to be up to you. I mean, that's something that I try to work with. If I have a student, a mentoring student, we try to work those parameters out from a mathematical standpoint and a psychological standpoint so that you get it right and you're successful. Because the more that you're successful, the more likely it is that you'll be successful when you jump your trade size. But you're not going to do it through compounding, and you're not going to do it through the growth of your account until you get to the larger account sizes. Let's say you're trading a $60,000 account and you're making 20% on that $60,000. So you're making $12,000 a year. That's another full lot. So once you get maybe another $800, instead of trading a $60,000 account, you trade $60 a pip. You can make it $70 a pip. Okay, but that makes it easier when you get to those higher levels, because then you can do that because the differential in the jump is not that big. So first of all is consistency, and then you get to the point where you're trading that $10,000 account. That first time you're trading a full lot, you don't want to jump from minis to a $30,000 position, even though you may be wealthy enough to do that. You just don't. You know, let's take any skill that you can think of. If let's say you want to be a professional lawn mower, mowing lawns for a living. So you get started and you mow your grandma's lawn and you mow your lawn. You get the skills so they start looking good. You don't go knock on somebody's door that's got a 2-acre grass. The guy's worth $4 million and he's got 2 acres of grass, and you tell him you're going to manicure his lawns because you're going to screw it up. You're not good enough yet. You don't know what a good lawn looks like. You don't have the confidence to say, hey, look, I've mowed my grandmother's lawn, and I've mowed my lawn, and I've mowed these guys' lawns, and I've done all this other stuff. Grass is grass. I can cut your grass. There's just more of it. And that's the same attitude that you want in your trading. I can trade one mini lot. I can trade 10 lots, 50 lots. But you have to have the skills to be consistent. And you have to have the skill to make those financial jumps, the jump in trade size, yeah? In other words, you're going to go from, let's say you're going to take that $10,000 account, trading one full, and you'll jump to 2 full lots. In other words, you're going to go from a $10,000 bank to a $20,000 bank. Now, if you're consistent, you may not need all that runway, may not need all that extra $10,000 to make the 20 in order to trade 2 fulls. Let's say your margin is $6,500. You might be able to open and trade 2 fulls with $7,500, not another $10,000, because you're consistently in your trading and you're not going to take a 100 pip loss against your account. And so you can then gradually begin to step up your trade size, your number of lots that you're trading, without the full $10,000 increments that you'd need to go up. In other words, what I'm saying is, if you want to go from a $30,000 trading account to a $60,000 trading account, you may not need to have the extra $30,000 to go to trade 6 fulls. But you can do that once you're really skilled. Well, what are the other things you can do when you're really skilled? You can scale in and out of positions. You can compound a little bit differently. There's all kinds of different techniques and strategies that you can do. You know, you watch these YouTube channels and you got these fools doing crazy, crazy stuff, and it looks great and they can make it work, but you're not going to be able to make it work because you don't have the experience to recognize it. You got to do what you're good at, right? You practice at the smaller accounts to develop your skills. And you go sell a truck or get a raise in your job, and instead of spending that on a $500 truck payment or something, you put that into your trading bank and you trade your minis for a while, and then you jump up and trade one full lot with a $10,000 account. You need that extra buffer. You can't say, well, I really only need $650 a margin so I can trade with a $750 size account. Well, you better not, because you might not be good enough to withstand 6 losses at 10 bucks a pip for maybe whatever loss level it is that you have. You know, if you take a big loss and you haven't enough money over that margin to carry that off on an average basis, you could very well not be able to trade 2 full lots. And then now you're going to be trading a full lot and a half. You're going to be trading at 15 bucks a pip. Now you're back into compounding, and you're needing to calculate your bid size every time you're going to get into bad habits. Look, if you don't have the skill to be consistent with a $1,000 account within about a 6-month period of time, it might take you a little bit longer. To be consistent at the $10,000 account size, it might take you 2 months. To be consistent at a $30,000 account, you might be consistent right away. But you got to pay your dues, and you got to you got to build a set of rules that work for you to develop that consistency at that mini account level, because those are skills that you can transfer upward. Just the fact that you can compound and you get lucky for a year and you're able to take that $1,000 account to $4,000 or $5,000 or $6,000 is no indication that once you go and all of a sudden you put $30,000 at risk, that you're going to be able to take that $30,000 to $90,000. That's probably not going to happen because you didn't build a solid enough foundation. You know, Larry Williams has been known to double accounts and to do fantastic things, and he's more of a commodity trader. But if you want to read a really good book, his book, I've got it here somewhere. Well, here it is, Williams. Long-Term Secrets, Short-Term Trading. Okay, read that book. And in it, he tells a story about not only the trading challenges that he's gone into and done really well at, but his daughter took a $10,000 account and ran it to $100,000 in, I don't know, 18 months or 11 months or something like that. These people know what they're doing, and they have a lot of money behind them, and so they're not having a fear of loss. You know, it's just a competition. And they know they're not. They take that $10,000 account and they push it and they push it and they push it, and then they got 20,000. They're not afraid of losing 10 because they've got $100,000 behind them. Do you have that kind of money? Well, if you don't, you can't trade like them. You can't have that expectation. It's just as simple like that. Look, trading is supposed to be fun. Let's make it fun. But be very aware of some of the conditions that are required in order for you to jump your trade size. Jumping your trade size is a simple process as long as you're confident that you are consistent in your trading at whatever level that might be. If you're trading at $30,000 account level size and you've been consistent with that for 2-3 months, as you have been consistent with your other account size levels that you've had in the past, that's great. You want to jump that 30 to a 60, go for it. Because you've got the money behind you that if you take those 6 losses up front, because you're sizing your trade size according to a reasonable bank size, you're not going to get beat up, and you're going to have the confidence, oh, geez, I took a bad hit, I'll be able to make that up. And you'll be trading at that $60,000 account size level. But don't go from 30,000 to 35,000. Don't do that. Work at it. The reason that you're working at the $30,000 account level size will be to gain that confidence to deal with money that when you lose it and win it is significant. If you're making 1% on a 10% on a $30,000 account, right, is $3,000. So if you could make 1%, $300 a day, that's more than the average daily wage in the United States today in 2022. Count that up. $300 a day, 5 days a week is $1,500. That's $6,000 a month. That's $72,000 a year. $300 a day. And you could do that on a $30,000 account. You're probably not going to trade 5 days a week. You're not going to make $300 a day every day. You have to take your losses into consideration, as well as the days that you're going to go, instead of making 300, you'll make 600 or 700. But if you take a $700 or $800 or $900 or $1,000 loss, you're not consistent, and you're not going to be able to successfully jump from 30 to 60, because you're just going to exacerbate the size of the losses. Instead of taking a $1,000 loss on a $30,000 account, now you're going to take a $2,500 or $3,000 loss on a 60. You're going to be screwed up. And that gets into psychology and emotional trading. And I know you don't want to hear all about it, because I did a video a few weeks ago on the psychology, the importance of psychology in trading, and nobody watched it. I put it up there. At the time, I had about 230 subscribers, and within 10 hours of posting a video, I generally get about 15 subscribers, right? And in the first 10 hours. Well, that video didn't get any subscribers for 2 days. Nobody wants to hear psychology. A little over 2 days, I got my first view on the video, and then on that third day, the early part of the third day, I got the second one, and the end of the third day, I got a third person. After 3 days, when I would normally get 15 in the first days. Nobody wants to listen to psychology. Read Mark Douglas's book. If you don't think that has a lot of meat to it, don't start trading, because you're just not going to trading in the zone. By the way, if you don't read his book and understand it, you don't have to remember everything he has to say. Just be aware that we're our own worst enemies. Okay? The idea in jumping your trade size is to make a shithouse full of money. Don't try to do that on a mini account. Peter Rose, Longwood Currency Trading. Have a great day, and have a great trading day.